In October 2007, the market's expectation of interest rate hikes became increasingly strong. But at the same time, the central bank seems to be working hard to eliminate its people's expectations. Zhou Xiaotuan, governor of the People's Bank of China, said in Shanghai on the 9th, it is expected that China's inflation will slow down by the end of the year. Before this, the central bank will not take new tightening measures and is unlikely to significantly tighten monetary policy. Central bank why show hesitation in raising interest rates. The U.S. interest rate reduction policy, which is currently deeply trapped in the subprime mortgage vortex, has to some extent kidnapped it. Objectively speaking, with the rapid expansion of the intersection between the economic fields of China and the United States, not only are the monetary policies of the two countries constrained and influenced by each other, but on the surface, the macro tone of the United States looks more and more like China, while China's capital and finance are more and more like the United States, but fundamentally, they are still far from each other. At the macro tone level, China's macro tones are basically characterized by peak shaving and belly filling, using heavy monetization as a means, and supplemented by in the hands of administration, the potential crisis caused by surplus should be peaceful evolution theory. This year's policies such as raising the reserve requirement ratio 8 times and raising interest rates 4 times fully demonstrate the painstaking efforts of macro adjustment in closing positions. After the long-term capital management incident in 1998 and the subsequent Nasdaq stock crash, the United States also learned to cut the peak and fill the valley to prepare for a rainy day. Firstly, through interest rate cuts and expansionary fiscal policies in the past 4 years, the turmoil brought to the United States by events such as the September 11 incident, the collapse of Enron, and the outbreak of the Iraq War was successfully resolved, enabling the United States to quickly emerge from recession and move towards prosperity. Then, it began to raise interest rates gradually to prevent the risk of foam caused by excess and inflation. This kind of regulation is undoubtedly successful. Even though the current subprime mortgage crisis has led to financial market turbulence, the third quarter data of the United States shows that the real economy is still going well, and the contribution of regulation cannot be ignored. However, there are not many other countries that are fully aware of this regulatory model. For example, in the Southeast Asian financial turmoil, those countries that failed to intervene in potential crises because they failed to smooth the cycle in advance have not yet understood the true meaning of peaceful evolution theory, so they have not yet been able to reproduce the growth miracle of that year. Of course, the similarity between the US macro tone and the Chinese macro tone is only superficial, because the regulatory essence of the two countries is different. In the subprime mortgage crisis, the Federal Reserve ignored the reality of soaring international oil prices and increasing domestic inflation pressure, the independent principle of the central bank that the overall situation should not be compromised for a small number of people, and the possible policy risks of interest rate cuts at the moment, thus laying the blame for Wall Street speculators who have played too hard with financial wisdom. The Federal Reserve has been hijacked by Wall Street, which is the result of the buttocks determine the brain. While China's policies are often confused by several interest groups, on the whole, macro policies are the greatest common denominator of the interests of all parties. At present, harmony is the weather vane, and the beginning of regulation from macro to comprehensive coordination is more a correction of the previously falsified policy line. In terms of capital finance, China seems to be increasingly following the US model. Rapid breakthrough in capital securitization rate 100% squeezed into the ranks of Western countries. Various forms of capital and financial formats, such as old brands such as Huoqi and Goldman Sachs, and emerging industries such as private equity funds and private equity funds, have emerged in the further opening up of China's financial industry and rapidly blossomed everywhere. Various local investment banks have also risen in various coastal areas, and the capital magic drama has begun. These prosperous financial scenes are no different from those of the United States. Unfortunately, the beautiful scenery on such a beautiful day only looks beautiful, but it cannot conceal the embroidered pillow in any way, the essence of head-rotting straw. The U.S. stock market is a classic market, implementing true full circulation, diverse trading varieties, rich market levels, and strict regulatory laws, as evidenced by the Sarbanes-Oxley Act. Taking it as a reference, China's capital market is a far different. In terms of stock market structure, the proportion of state-owned shares is too high, and the prevalence of 28 or even 19 phenomena inevitably gives people the illusion that the planned era of state-owned enterprises unifying the world has returned. In terms of institutional construction, although the pie has been expanded, the circulating market value is only 1/3. The trading variety is single, and can only be long and not short. The entire financial market level is also very thin, and the bull market is only a feast of state-owned ownership, unrelated to the large number of small and medium-sized enterprises suffering from capital thirst. As for the Chinex and property rights trading markets that the latter eagerly hopes for, after more than a decade, it is still in the stage of establishing as soon as possible. 3. In terms of market regulation, in the face of chaos such as the emergence of new houses and stock price fluctuations, although the Public Security Department has provided protection for the regulatory authorities, there is still a lack of substantive action. All these strange phenomena in the Chinese stock market are hard to trace in the US capital market. At present, the macroeconomic regulation of China and the United States is actually facing a common enemy, which is mobility sexual excess. As the inevitable result of deepening the market economy, surplus is often manifested as various form, so it is often the precursor of economic crisis. If not handled properly, it is easy to achieve a new system balance in the form of local or systemic crashes, which has an incalculable impact on the economy. In the face of the irrational prosperity of the stock and real estate markets in Japan, Japan originally wanted to emulate the UK in creating a financial explosion, in order to take advantage of the crisis and create a financial powerhouse. It did not want to scale the chicken and not eat the rice and blow up the Japanese economy. At present, China and the United States, which have learned to smooth the cycle to ease the crisis in the macro mode, are expected to follow the path of peaceful evolution theory in the next liquidation of excess positions, although their expressions may be different. As far as the United States is concerned, the subprime mortgage crisis is a partial preview of monetary surplus in the context of financial civilization, although the Federal Reserve the several rate cuts were somewhat embarrassing, leaving the international community with a negative impression of being hijacked by Wall Street, but effectively weakening the momentum of the crisis spreading rapidly to the physical sector. In addition, with the rumor of the US dollar will depreciate significantly in 2008 spreading all over the world, countries have significantly reduced their holdings of US Treasury bond in recent months in order to escape from this seemingly unstable ship as soon as possible. However, President Bush, Treasury Secretary Paulson and others have successively refuted the rumor, which seems to be full of confidence. The bottom line for closing a position may be to shoot the first bird. At present, one of the threats to the US dollar is the euro, and the other is the Chinese yuan. In dealing with the euro, the United States is very familiar with it. It has declared war on the surrounding areas of Europe every 4 years, from the Kosovo War to the Iraq War to the Iran War, which is about to be stirred up. Its intoxication means nothing more than fighting cattle across the mountains, and it can recruit all kinds of international capital by suppressing the European economy. Dealing with the renminbi, the United States has both a black face and a red face, and from the results of several rounds of competition, it may be a tug of war. As far as China is concerned, the methods of closing positions may differ from those of the United States. China's surplus includes both overcapacity and including currency surplus. Although overcapacity is also driven by factors such as currency surplus, its formation is mainly related to the investment triangle love between enterprises, banks, and local governments. Therefore, for overcapacity, relevant departments generally use mandatory and administrative measures to shake up positions, such as ordering investment projects to stop working and suspending corporate loans. In this way, a large number of bank bad debts will be generated, but there are precedents where the central bank and the Ministry of Finance have paid for it, who generously injected funds into the four major banks. As for currency surplus, it is essentially a sweet worry. Although the central bank has warned that the economy has entered the overheating zone twice, and signs of overheating such as overall price, house price, and stock price increases are all caused by currency surplus, objectively it is a fate. If guided reasonably, the benefits outweigh the disadvantages. The channel for dealing with excess currency is likely to divert it to the capital market, making the stock market bigger and chaotic, enabling it to bear the responsibility of evaporating liquidity and allowing excess currency to peacefully evaporate in the virtual world.